And I've seen a lot of people talking about Wyckoff. And I thought, you know what? It might be worth having a look, see where this is and why they're talking about it. And then I thought, well, actually, some people in the group may not even know what this is. So, but I'm just going to quickly run through how it's supposed to work. And then I'm going to talk about what people in the crypto space are relating it towards. And I think you'll find it quite interesting, actually. So this came about in the 1930s by Dr. Richard Wyckoff, and he came up with this Wyckoff accumulation and distribution method to analyze trends within markets. And the basic idea behind it being that the method is that the price moves in repeating patterns of either accumulation or distribution. And those patterns are usually identifying potential buying and selling areas or opportunities, which are usually, I say usually, triggered by market makers, big players within the market. And how he goes about sort of understanding this, he has effectively three fundamental laws, which I will try and run through, but they are supply and demand, cause and effect, I'm down here now, and the law of effort and results. So supply and demand, we're probably generally quite au fait with supply and demand. But if demand is greater than supply, obviously price is going to go up. If it's the other way around and we've got more supply than demand, then price is going to go down. And if they're pretty much countering each other out, we're just going to be in a period of just bouncing around. And so what he's saying there is that bullish movement as soon as demand exceeds supply. And on the other hand, if supply exceeds demand, we're going to see the prices ultimately fall. And then we talk about this law of cause and effect. I love it how they sort of like first law or second law, they make it like it's some sort of scientific principle, which maybe it is.
So, Harry, can you zoom in a little bit?
Yeah, of course I can.
A little bit small.
Sorry, there you go. Is that better or is that even better?
Great, thanks.
There we go. Sorry there. I can't remember which one I was on now. The cause and effect, I think it was, wasn't it? So the state there, the difference between supply and demand isn't random, but it's actually logic between that. And so it's whether or not we're in a phase of accumulation or a phase of distribution, and how we then get to either of those two phases. And we'll go through those, but they're effectively called a markup or a markdown phase. Probably work out which one. It's which the accumulation comes after a period of preparation, especially economic events. In this phase, accumulation leads to an uptrend effect, so that's the markup. Similarly, in the distribution phase, the price decreases into a downtrend or the markdown, which we will go into. So just talk about the law of effort and result, and then we'll try and go through the four phases. According to its third law, the price moves due to effort. So that's effectively volume. So when we do look at it, what you want to be looking at, if you do use this, is yes, price action, obviously, but we want to also have volume on your chart. And it's something that I've ignored for quite a while, just because, you know, I other indicators there, but I'm starting to lean a lot more towards volume. I think it really can give you an indication of whether there's any longevity between movements. But anyway, I digress there. So price action trading volume shows the same sentiment. The current trend has a greater chance of continuing. So if price is going up and volume is increasing, chances are that that uptrend is going to continue. But on the other hand, if price is going up but volume is decreasing, what we're saying here is that that's creating a divergence, and it's likely going to either pause or actually reverse. And it goes into an example there. So got a nice little picture, if any of you couldn't imagine effectively what those look like. But as I said, there are those four phases. So we've got the markup phase. It's starting here. I'm starting here. The first phase of accumulation is categorized by an uptrend in the price and an increase in volume. So we've got both of those working in the same. Then we get to the distribution phase. So distribution area overbought over here. That's a downtrend in price and a decrease in volume. So we're starting to see those level off, and then it's going to tick the other way. So either the price is going to change with the volume up, or the volume is going to start to drop while the price continues. It's going to have a tipping balance that will create that stagnant area. We'll talk about what happens in there in a moment. And then you got the markdown phase. So that's where now price is decreasing and volume is also increasing. So that's going to create that sharp drive back down. So then leads you back into this accumulation phase, which start to see that misbalance again of either price or volume not lining up with the other, creating that ranging period and then the reversal through. So effectively, when we're in that accumulation phase, smart money, market makers, big players, whatever you want to call it, they're buying. They're buying as people are starting to sell. So they're actually buying. That's what the Wyckoff principle is that they're buying when everyone is selling. Okay. And then you can guess what happens when we get to the distribution phase. They're selling when everyone's starting to YOLO in and getting it. And I think we kind of generally are aware of that, but just to reiterate where that is. And basically the Wyckoff method then is using, it's not as simple as this, but it's using this understanding to try and find levels where we think people are either accumulating or distributing. And if we know where those are, we can also follow suit. So I'm going to scroll past that. Sorry, if I'd had a bit more time, I would have gone into it in a bit more detail. And so this is what an accumulation phase would look like. And this is an interesting diagram because, as you'll see, how I overlay that on BTC right now. And in theory, it works in any time frame. You just obviously the moves are generally a bit smaller, but there's a little key here that kind of explains where we got. But preliminary support appears to be a long bearish trend. So we remember we're in an accumulation phase. So price is falling, and we're going to get to a point where it's falling. But guess what? The big players are buying. So it's a long bearish trend. Traders may experience high volume and spread widening. And the first indication of seller pressure, and the buyers may control the price. Then we've got the selling climb so that's the peak selling. Price beginning to sell off, and we violating preliminary support. This is the panic selling phase, that peak phase I mentioned. After a while, the price may reverse, so we may see wicks in that instance, when the spread might extend to an extreme level, and in the end, the price closes far from the low level. So yeah, a long wick candle. There we go. And then an automatic rally. Nothing goes down in a straight line, so you just have that initial relief rally from it. And as I said, it can be disastrous for sellers. Because after the selling press, the price reverses and recovers all of the movement shown towards the seller's direction. So they all think, oh my God, we just sold. The price is actually completely recovered. I've FOMO'd, going back to that. The higher this movement determined by the higher the range, which is a significant barrier for most. And we start to now see in here, and you can see them on the charts, these start to form levels that you want to then keep an eye on, because they're going to tell you when we're starting to leave that phase. Secondary test. So the secondary test is after that automated rally, we're going to see a further fall, but generally creates a higher low, as you can see in the diagram. That continues to range through, but then we have this thing called the spring. The spring, so this is price will perform a hard test of the recent lows, misleading traders. After watching the spring, average traders consider that the market trends bearish and they'll start selling. However, by this time, the market makers have already filled their buy orders. So what do you think they're going to do? They're going to start moving the price up because they've already got what they need. And then, yeah, accumulating schematics, the last stage of the accumulation cycle, the price should break out from this range and off it goes. So that kind of is explaining it from an accumulation point of view.